Good afternoon, everyone. So just a brief introduction. My name is 𝗠𝗍𝘃𝗁. I'm from HSBC Asset Management, and I lead the Asia liquidity sales team in the region. And of course, HSBC Asset Management is the global asset management arm of HSBC. Today, we manage over $750 billion of assets across different asset classes and strategies. So I'm going to be talking about something that is hopefully very relatable to all of you today. I'm going to be talking about cash, right? And I'm sure many of you know what it is and what you use it for. So what do you use cash for? Why do you keep cash in your bank account or even in your wallet? You use it to meet your daily and known expenses, you use it to pay your credit card bills, your home loans, and so on and so forth. Or you might be saving up for a larger transaction, for instance, to make a down payment on your BTO, on a condo, or even for a car. And I'm sure a lot of you have heard the concept of saving up to 3 to 6 months of your monthly expenses as emergency funds. I think that's always something that is very prudent for all of us to think about. So you might keep some emergency funds in your bank account as well. And last but not least, I'm sure you guys think about investing in the market as and when opportunity arises. When you see a dip in the S&P 500, for instance, or you want to take advantage of some of the other funds that are out there at this Fund Supermarket conference today. So cash is a concept that many of you are very familiar with. But what is the similarity in order for something to be considered cash or cash equivalent? Number one, it has to be liquid, right? It has to be available as and when you need it without any form of lockup. Time deposits are, of course, considered cash, but the liquidity element is not there. Cash technically should be able to hold its value over time and be immune to market volatility that comes from time to time. So you're looking for something that is liquid, but at the same time, allowing you to hold its value. So what are some of your options out there? I was just looking at the landscape for Singapore over the last 2 years, and I see that there has been a lot of platforms that are out there, fintech startups, providing solutions for cash, guaranteeing you returns. I'm sure a lot of you have high interest rate bank accounts as well. If not with HSBC, probably with UOB, OCBC, or DBS. So these are some of the options for you to consider. But what about the stock market, right? The stock market has been doing very well. I'm sure it's no surprise to all of you that S&P has returned more than 20% in the last 2 years. The STI has done pretty well as well, delivering a return of 17% over the course of last year, which I think is one of the best years ever. So you might be tempted to say, hey, look, if the equity market is doing well, let me put some into the stock market. Now, the problem here is, of course, volatility. The black line over here shows the VIX index, or the volatility index, which is typically used as a measure of US equity volatility, expected future equity volatility. And the red line here is what we call the World Policy Uncertainty Index. So if you just zoom in into the right-hand side of this chart over here, you see something pretty interesting. Over the course of the last 2 years, world policy uncertainty has gone up quite a bit, but yet equity market volatility has remained relatively benign. So what are we trying to say here? So there is obviously a chance that some of this world policy uncertainty is not being priced into the equity markets. Now again, I'm sure you heard earlier from the speakers today about the projections for the stock market for this year, so I'm not going to talk so much about it. But when we think about cash, it's typically not appropriate to invest your cash in these type of asset classes because of unexpected volatility that might come up from time to time. Right? And the last thing you want is for you to have to sell your holdings at a loss in order to meet your cash flow requirements, right? In order for you to make that down payment that you saved up so hard for, your BTO, or even that condo that you have been eyeing for so long. So an appropriate solution for cash needs to be able to hold its value. It needs to be relatively liquid, and needs to be able to give you a rate of return that's arguably better than your bank account. So let me talk a little bit about just putting cash in your bank account, right? Sure, it's safe, it's protected by the SDIC up to a certain amount. And a lot of you have banking relationships that you do need to maintain with your banks. But the problem here is, of course, inflation. So let me start off with the good news here. The MAS has done a very, very good job of bringing down inflation over the last 2 years. And if you look at the black line over here, core inflation has slowed down to a rate of 1.9% as of end November, and the CPI has broadly fallen in tandem as well. So the good news is that, inflation, MAS has been able to control inflation, so hopefully your plate of chicken rice is not going to become more and more expensive. Last I checked, I think you can hardly get a good plate of chicken rice for under $5 now. If you do know where to get it, please come and find me after this presentation. So the point here is about inflation eating up the purchasing power of your cash. If you look at the impact of inflation, at 2% inflation, over 10 years, your cash would have lost 18% of its purchasing power. So that's a very, very important thing to keep in mind, right? I hope none of you are putting cash under your bed right now, or not just putting it in a current account that's not providing you any interest rate. On the flip side, we can take a look at the SORA, which is the Singapore Overnight Rate Average. The gray line here represents SORA, and you can see that it has tracked US interest rates quite closely over the last 2 years since 2022, when the Fed embarked on an aggressive rate hiking cycle. It's no surprise that SORA has gone up. Why? Because Singapore is an open economy. The MAS has a policy to track US and global interest rates. So SORA has remained at historical high levels, and I'm sure a lot of you would have seen that from some of your home loans that are pegged to SORA. Over the last couple of years, SORA has been on a steady upward trend. In recent months, it has come down a little bit, but honestly, if you look at this chart over here, it is still pretty high. So on one hand, you have inflation, which is under control, but nowhere close to zero. And on the other hand, you have relatively high SORA rates that you should arguably take advantage of. So how do you try and take advantage of high interest rates today? I'm going to introduce to you guys the concept of a money market fund, which is something that has been in existence for a couple of decades now, but for the benefit of the audience here, I'm going to do a simple introduction of what it is. A money market fund is a type of mutual fund that aims to preserve capital and provide liquidity. Now, contrast it to other types of money market funds, where if you look at the investment objectives, they would never ever say that their investment objective is to preserve your capital and provide liquidity. They will say something along the lines of, our aim is to beat the benchmark. If it's a fixed income fund, you'll be looking at a global aggregate index, for instance. If it's an equity fund, then you might be looking to beat an Asian benchmark. So there is a very, very important difference here. The investment objectives of a money market fund is always to preserve your capital and to provide you liquidity before we think about providing you returns. So how do we achieve that? Typically, we invest in lower, shorter term type of investments. For instance, money market instruments such as government securities like government bills and so on and so forth. And these are typically lower volatility investments that might not be correlated to the market. So let me give you an example. In our Singapore dollar money fund, we do invest in time deposits. And as you know, the risk that you have in time deposits is essentially to the bank defaulting. If the bank doesn't default, you technically get your cash back. So that is where we can talk about a money market fund as a slightly lower volatility type of investment. So as I said earlier, this is something that has been used by a lot of institutional investors globally. You're talking about sovereign wealth funds, insurance companies, pension funds, and even multinational companies globally. So we're talking about the likes of the Fortune 500 type of companies, the likes of Meta, Apple, Google, and so on and so forth, and even NVIDIA for that matter. Chances are, if you do a quick Google search and look up their annual report, you'll find that they have a healthy allocation to money market funds. So this is one of the best kept secrets in the institutional world. Now, why hasn't it gained traction amongst retail investors? The main reason, of course, is that until 3 to 4 years ago, the rates for money market funds aren't that exciting to retail investors. But of course, this has changed in the last couple of years. Today, the cash that you put in a bank account is arguably, there is a cost of putting it just in your bank account if you compare it to the returns that money market funds are delivering to you. So what are some of the important features of the fund that consider it to be a money market fund? It has to provide you with same-day liquidity. In the institutional world, we like to think about it as a T+0 type of liquidity. While we can't achieve that in the retail space, but you should be still looking at a liquidity of, say, T+1 or T+2, depending on the platform that you go with. There is stability of your principal, which means that you're not having to worry about mark-to-market fluctuations in your fund. And so arguably, investing in a money market fund should allow you to sleep pretty well at night. Another feature that I want to talk about is the external rating that is often given by international credit rating agencies such as S&P, Moody's, and Fitch. I'm sure all of you are familiar with what these rating agencies do. And a lot of times, what they do is to give a AAA rating to the best money market funds out there. So if you are on the hunt for a money market fund, you should definitely be looking at one in which it has a AAA rating, which I'm going to share a little bit more later. And I would also urge a lot of you here to really try and understand the investment approach and the track record of the investment manager, because different managers would have different ways of managing their money market funds. So I would just like to highlight again here that the foremost objectives of a money market fund is always to aim to preserve your capital, to provide you liquidity as and when you need it, and last but not least, providing a yield that is commensurate with short-term rates, but of course within the risk framework that we talked about earlier. So why HSBC Asset Management? So allow me to sell a bit of 𝗪𝘃𝘀 here, okay? So when we talk about HSBC Asset Management, we are not new to this market, right? As I said earlier, we have more than $750 billion of AUM today, and a large proportion of it is in money market funds. So we're looking at roughly in excess of $170 billion of AUM. Importantly, we have a good track record of managing through different crises. And having this experience allows us to think about how to manage through the next crisis and to hopefully allow investors to always redeem their capital as and when they need it. I'm going to talk a little bit about risk management here. And over at HSBC Asset Management, we always think about having a globally consistent risk management framework. So whether we are managing a currency that is in Hong Kong dollar, whether we're managing a US dollar fund, and so on and so forth, we always think about having a globally consistent risk management framework. And again, we are not new to the region here. Despite the fact that we only launched our Sing Dollar fund last year, we have actually been in the Asia region for more than 3 decades now. Our Hong Kong dollar fund was actually launched in 1991, and we managed a couple of currencies in the Asia region as well, such as Australian dollar, RMB, Indian rupee as well. So moving on, just to summarize a couple of reasons to consider our Sing Dollar liquidity strategy. We are the first international asset manager to be offering a Singapore domiciled money market fund strategy. In fact, I think we are also the first international asset manager to be launching such a product that is available to the widest retail market today. The investment minimums are pretty low. It just starts at $1,000. So it's easily accessible to many of you here, or even to most of you here. I'm going to touch briefly upon the point about investing in securities with a high credit quality. So as I said earlier, it's important to look at a fund that gives you a AAA rating. So our Sing Dollar Money Fund is AAA rated by S&Ps. And that is a AAA rating that's given not just because of the underlying credit quality of the fund, but also given to the way that the asset manager manages it. So which means that when S&P evaluates us as an asset manager, they look at both the underlying credit quality as well as our risk management approach in giving us this AAA rating. Earlier on, I talked about making your cash work harder. So this fund is meant to give you a yield that's competitive to Singapore overnight or 1 week short-term interest rates. And of course, even if you are concerned, as some of the other speakers have talked about earlier on, even if you are concerned of rates starting to come down later this year, or the MAS taking action at the next policy meeting, you can be assured by the fact that our portfolio managers are able to lock in prevailing term rates should rates start to come down. And so the fund technically should perform relatively well to short-term time deposits. And last but not least, the fund aims to provide you with daily liquidity, which means that there is no lockup and there is no conditions to redeeming your cash. The liquidity that you have will be T+1 via most channels. And again, no restrictions, no gimmicks, no lockup. You earn yield and you accrue interest for every single day that you're invested in our fund. And of course, your cash is available to you when you need it the most. To talk a little bit about the overview of the slide, or overview of the fund over here, I'm not going to spend a lot of time, but I just want to draw your attention to the fact of what we invest in, right? So if you look at the way that we manage the fund in the risk-managed approach, we are really investing in things that are very, very easy to understand. So we don't invest in derivatives. We don't have FX exposure. We only invest in Sing Dollar denominated type of securities. So this includes time deposits, in which we leverage the institutional purchasing power of HSBC. And we also invest in treasury bills, which are obviously MAS bills, Singapore government treasury bills, and so on and so forth. As of the latest date, you will realize that over 50% of the fund is actually invested in Singapore government securities, which means that your underlying exposure, majority of your exposure, is technically to the Singapore government. as rates start to come down, we might also start to extend duration in some certain parts of the portfolio. And that's where you see the 3 to 6 months or 3 to 6 months bucket of the portfolio start to increase a little bit more. So I'm running out of time here. I'm just going to briefly talk about some of the key takeaways from today's session. I hope you guys found something useful to take away today. Money market funds clearly have a role in your overall cash holdings. They are a low volatility instrument that invest in high credit quality type of instruments, and they aim to preserve your capital and provide you liquidity as and when you need it. And of course, not all money market funds are the same, and we urge you to consider the different funds out there and to have a conversation with your financial advisor or with your banker to understand the differences. Just to sum up, HSBC has more than 3 decades of experience in managing such strategies, and we look forward to talking to you at the booth if you so decide to come by. Thank you so much.